The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Show with Steve Sedgwick, and these are your headlines. Amazon shares under pressure after the tech giant issues disappointing guidance for the current quarter, but talks up its capex plans with spending to hit $100 billion this year.
When AWS is expanding its capex, particularly in what we think is one of these once-in-a-lifetime type of business opportunities like AI represents, I think it's actually quite a good sign.
But it's not all about tech. Europe's stock 600 closes at an all-time high, lifted by a raft of upbeat earnings as attention turns to today's US jobs report.
Well, the Bank of England delivering a blow to the UK. Chancellor of the Exchequer, Rachel Reeves, halving its growth forecast for the year and flagging fresh concerns over the government's fiscal plans as it cuts rates by a quarter point.
I think the budget is a factor in it, but it's wrong to point to only one thing going on at the moment. There are quite a lot of uncertainties out there in the world at large, and as I say, the weakness of growth actually goes back before the budget.
And L'Oréal misses quarterly sales forecast, with revenue rising at the slowest pace since the pandemic, amid weakness, yes, you guessed it, in China, but also in North America.
It's been another big week in tech, and the latest is Amazon. Its shares falling after hours despite a beat on the top and bottom line in the fourth quarter. That followed softer than expected guidance for the first quarter, with Forex effects, including a stronger dollar, projected to deliver a $2.1 billion revenue hit. The company also projected around $100 billion in capex in the coming year as it continues to ramp up AI spending, well ahead of forecasts from Microsoft, Alphabet and Meta this earnings season. Speaking to analysts, the CEO, Andy Jassy, defended that AI spending.
We don't procure it unless we see significant signals of demand. And so when AWS is expanding its capex, particularly in what we think is one of these once-in-a-lifetime type of business opportunities like AI represents, I think it's actually quite a good sign, medium to long term, for the AWS business.
We've got Arjun with us to break down the numbers. Arjun, was it the $100 billion or was it the $151 billion that was the issue? And the two numbers here, the $100 billion, the spend, and we know that the market is a bit cautious now around AI spending, but the $151 billion was the forecast for the sales print that lies ahead. And the market thought the forecast would be better than that. So if you've got a company spending its way to growth and the growth is not on the other side, is that the issue here?
A little bit of everything, but I will say, I actually think Andy Jassy did a pretty good job of finessing that $100 billion figure in the way that he explained how he sees it playing out. And it's important, I think, to dig in to his comments around DeepSeek, I think, on this, in which he said, he gave an insight into his view on how he thinks the model landscape will play out. And he says, look, we've always thought that there's going to be multiple models being used. Amazon has their own set of foundational models. But ultimately, if efficiencies are there, and this is the line we've heard from the rest of the tech world, if the efficiencies are there and the unit cost comes down, we think this is going to push this technology further, more widespread. And that means we will need more infrastructure. We will need more compute at this point. So I think he did a okay job, but I do think the number is scary on top of, combined with that forecast.
But very interesting, isn't it? $100 billion 2 weeks ago would have got you X. Yeah. $100 billion in the brave new post-DeepSeek world gets you X times, well, whatever. So actually, the number itself is enormous, and it outspends Microsoft, Meta and Alphabet as well. The numbers are enormous across the board. But that's really exciting for the buyers of product, for the buyers of these chips, for the buyers of the technology. Surely they get a lot more bang for their buck now. Yeah,
I think so. If there's more sort of competition in some senses, or there's a sense that actually, do we need as many models? Maybe there's a bit of a negotiation that can happen on that front. And I think also remember to put that number in context. Yes, it's bigger than Microsoft and Alphabet, but actually Amazon is a bigger cloud business as well, and it's still growing 19% year on year. We saw in the quarter it still accounts and is incredibly important for the Amazon business for nearly 50% of the company's actual profit. And that's pretty crucial as well. And so I think it was generally quite good. Look, the cloud number definitely could have been better. I said this before. I think going into the report, in line is probably not good enough. That cloud figure could have definitely been better and surpassed expectations. But still, Amazon is managing to eke out growth in cloud, and that's what the market wants to see.
The analysts have had a chance to run the numbers now, thanks to all the companies reporting, and they've tallied up with the spend from Microsoft, Alphabet, Meta, beyond. The numbers, 230 billion now estimated for this year. We were talking the other week about Stargate being, 500 billion over 4 years. Do we need the 500 billion over 4 years if these companies are throwing a truckload of cash at the AI infrastructure right now over the next 12 months?
I think when the Stargate project is an interesting one because it's driven by the government. And I think there is a thinking sort of more broadly, more geopolitically from governments around the world that actually we need to own more of this infrastructure or have a hand in some of this infrastructure. There needs to be national infrastructure. You probably hear words like sovereign cloud, sovereign AI, i.e. the idea that these servers and data centers are on the actual physical soil of the countries in which they're serving. And so that's, I think, part of what Stargate's trying to address here. Of course, the investments Amazon, Alphabet and Microsoft are making, these are global investments. So they are building out data center infrastructure globally at this point to service all the regions and the customers around the world for cloud. And I think, this is an interesting point. Again, what Andy Jassy was saying about models. He goes, we offer DeepSeek R1 on cloud. And so we think we're in a good position. And this is, I think, what now going into the coming quarters the market's going to want to see the cloud players growing because they are offering all these services.
That's a great point, that they're leaning into DeepSeek, and there are benefits there if it does materialize. Now, the impact of DeepSeek's new AI model is set to be a key focus in the tech sector as earnings season continues. CEO Rene Haas has told CNBC he is optimistic about the effects that the new technology could have.
And maybe I'll talk a little bit about this DeepSeek because there was a lot of folks speculating about what that might do for end demand. For ARM, it's a great thing because you end up having much more efficient models, and more efficient models means you can run inference in more endpoints. And the key thing in these endpoints, and when I talk about endpoints, these are your earbuds, your mobile phone, your PC. These are power-constrained devices, meaning you've only got so much electricity battery to run all the applications. So if AI can run in a more efficient way at these endpoints, that just drives demand. So it's great for us.
Yeah, absolutely. Right, attention will be on the US non-farm payrolls data later today, with forecasters expecting a slowdown in a number of jobs added whilst unemployment remains stable. That would keep the US economy at what's seen as full employment. And the Federal Reserve in its wait-and-see phase. Well, the markets week today have been solid but unspectacular across the board, Karen. I know that we've had small gains on all of those major three indices, but despite the wealth of big numbers we've had, it's been pretty stately progress.
I think it's linked to what we just kicked off the show with, the big technology names, as we've seen reaction on a daily basis to earnings that has been undermining some of the trade that we've witnessed. What was fascinating yesterday, and perhaps why we edged higher in some of the trades, was that Nvidia was back in motion. And don't forget, as we talk about that huge spend on AI infrastructure, it benefits the Nvidia story. And DeepSeek has been something that's been pushing back against the narrative that we need all this spend. Do we need all of these very high-priced chips? But Nvidia back in the game yesterday, as we saw the hyperscalers, the latest one to report, of course, being Amazon, still showing demand for those chips. So Nvidia, top moving name for the S&P 500 and also the NASDAQ. But over the course of the last number of sessions, you have seen the undercurrent from stocks in the technology space that are dragging on the index. Yesterday it was Salesforce's turn. Again, this has been a stock that has been benefiting from some of that pivot towards which companies are going to benefit from DeepSeek, which companies have spent a little bit less on AI. And Salesforce has been one of the rotating stocks for some investors. But yesterday it was down. It was the lower trade on the Dow, the undercurrent there from Salesforce, also on the S&P 500, the worst performing stock. So again, technology, and you can see it on the ARK Innovation Fund that has lost a little bit of steam this week. To Treasuries, we are setting up for non-farm payrolls day today, and expectations on the back of the jolts, the ADP. Markets looking for a little bit of evidence around cooling in the labour market. So we are closely watching the impact on bond markets. So the 2-year 4.22 is where we're perched. Now, we can't miss the European markets because if you haven't been looking at them, they've quietly climbed to a fresh all-time high, despite all the conversations this year, all throughout January, about US exceptionalism. The market here has peaked, and we've seen it on the DAX, the FTSE's climbed, the Italian stock market contributing. So all of these individual markets, the exception's been the French market, not quite there yet, but the stock 600, you can see at this high, up another 1% yesterday, 544.84 across the board. You can see how much the other major boards bounced in session yesterday. To the Asian markets, and again, if you're just looking at those US markets in isolation, you've probably missed out on the trade over in the Asian markets as well, where the deep-seek trade has gone on when it comes to technology plays. That's bolstered fortunes domestically. Hong Kong, Shanghai, both trading high today. And you can see in particular, we take a look at the technology plays out of the Hong Kong market. This is where the concentration has been. Lenovo leading the charge today, up about 7.5%. Li Auto stronger, but Xiaomi, that is a decent build today, 3.7%. Hong Kong Tech itself up 1.2%, and even more compelling over the trading week. Now, US futures, what are we gearing up for on non-farm payrolls day today? We're looking for somewhat of a cautious start to the session as investors just hit the sidelines and waited out for some numbers. We are looking for a slightly downbeat start here, Steve.
Yeah, Karen, I always big up the payroll because I have done historically when I was in the business and now obviously, but am I right to? Let's ask Neil Wilson, Co-Chief Executive Officer and Co-Investment Officer at EJF Capital. Neil, lovely to see you. Am I right to still get excited? I have this thing from when I was a young man, a young trader, that I still get really excited about the payroll. But am I over-egging it these days?
Well, I don't think in general, but I do think this month is going to be sort of not that important. They're expecting 170,000. It's been 200,000 the last few months. January could come in a bit lower just because we had a cold snap in America, and then you had the LA kind of wildfires, natural disaster. So that'll probably it could be a suppressed number. I think what I would look at is the Bureau of Labor Statistics is putting out their revisions for March 2023 to March 2024. Okay. And that number, the expectation is 600,000 to 700,000 decline in expectations. Wow. But if you see a big print like 900,000, which some people are projecting, that could really affect the market.
Excited if there's a big decline in employment, that magnitude, could get excited about more rate cuts to come then?
Right, exactly.
But the Fed, quite rightly, just like the Bank of England yesterday that I was at, needs to be really cautious. Nobody really knows the ramifications of Trump. We can talk about 1,000 other issues, but let's be brutally honest, whether it's on tariffs, on trade, on immigration, they're all going to have a big effect on the US economy and the global economy.
He is intentionally unpredictable. And there is, I like to call it the bluster alert. There is a bit of that because the president has some real powers, but he's not going to get Congress to act on tariffs and pass some new law that's widespread. But I think he's using it as a tool. And I think, unfortunately, what I worry about as an American is that his hard use of tariffs undermines Americans' soft power over time. And so I think maybe some of the inflationary concerns are a bit overstated because he's using it as a threat. But I think long term it's just not helpful overall.
Can we talk about sentiment around the tariffs? Because the market all along thought this would be a negotiating tactic, got pretty scared that in fact we're going to get the implementation of tariffs. It could be the hard trade policy that the market had feared, and now they seem to be somewhat more relaxed and just pushing out into the distance the threat of tariffs. What do you make of how the market is positioned and whether there could be another shock factor coming on tariffs? Well,
with Trump, you never take the under on shock value. So, but no, I think the market is basically just anticipating that this is bluster, this is negotiation. Where I would be cautious on taking that view, and the market may have it not quite right, is that there's two uses of tariffs that Trump is, I think, taking. One is as a trade negotiation. Okay, that's being dismissed or being discounted a bit. But there are some tariffs, like with the EU, for example, where he's doing it to try to level the trading tariffs between the two countries, where cars are higher tariffs than they will be for American imports. So I think there's some areas where it's really trying to even out the tariffs to make them equal, or perception of equal.
Would you be worried about the European stock markets trading around a record high before we have any clarity on tariffs?
Absolutely, absolutely. I mean, the things that I think gold is interesting. I think I was at a dinner last night talking with an ex-SEC commissioner, and I think there's going to be some real regulation in digital currencies, digital assets. I think those are interesting. I mean, Bitcoin's a separate item. That's more like digital gold, as you know. But I do think there's going to be some regulation and there's going to be some movement in that area, which is interesting. But I think in terms of trade, America, I think the market is understating some of the volatility that we should expect.
We've also got a market that is trading around these tech themes very aggressively, around the DeepSeek story, around the earnings and the build out we're seeing in the United States and who could benefit, whether it's a higher spend if you build it and then you get the growth down the track, or whether you spend a little bit less and you still benefit. I mean, and these themes are very dominant on the American market, but also in the Chinese market right now. How do you play that theme? Because we've really stretched on from this US only stock market trade where we started January. Those bets have been spread fairly wide now.
Yeah, no, look, I think the initial shock of DeepSeek is now kind of digestion's taking place, and folks realize that it's actually probably a positive for the technology companies and for the chip makers. Ultimately, maybe in short term it's not, but long term it certainly is. And I think that's the way technology goes. But you're seeing, look, with Amazon, you're seeing, today with the CapEx that it's going to have a big impact, and it's coming in lower this morning. It's going to probably be lower the rest of the day.
And Neil, thank you so much for joining us. Neil Wilson with us, Co-Chief Executive Officer and Co-Chief Investment Officer at EFJ Capital. Let's take a look at what is coming up. We're going to hear from Minneapolis Fed President Neil Kashkari today, that exclusive interview at 13:40 GMT.
Right, so the Bank of England cut its key rate by 25 basis points, lowering it to 4.5%. All members of the MPC voted to reduce rates, but 2 of the voices called for a 50 basis point cut. The extraordinary thing is, we were here chatting to JP Morgan this time yesterday, and Catherine Mann, she's going to be the hawk. Wow, no, she's the zeal of a convert. We went to 50 basis points from 25, and Swati Dhingra underlining how serious some members see the UK's low growth problem. GDP is now expected to increase by just 0.75% this year, half the previous estimate. The bank also warned it sees inflation peaking around 3.7%, with low growth and rising prices raising the prospect of stagflation for the UK economy. I want to have a long chat with Karen about this a little bit later on, but it also said it's keeping a close eye on US tariffs, warning more protectionism would have a negative impact on the world economy. Governor Andrew Bailey told me that whilst there are still uncertainties around tariffs, the effects will need to be monitored.
In terms of growth in the world economy, if this will lead to a fragmentation of the world economy, that is not good for growth, and we've made that point today in the report. The impact on inflation is more ambiguous because it depends upon what other countries do in response. It depends on what the consequences of those actions and reactions are for trade. To what extent does trade get redirected, and what effect does that have on the price of traded goods? And it also depends upon exchange rate movements as well.
Oh, we're looking forward to hearing more from that interview. Coming up on the show, sales at L'Oreal disappoint with one key market underperforming. Charlotte will have the details. Plus, President Trump continues to push for NATO members to increase defence spending. We'll speak to defence equipment maker Saab on their full-year results later this morning. And Sabadell in Spain, its net profit surges 75% in the fourth quarter as it continues to stave off a hostile takeover from BBVA. We'll speak to the CEO, Cesar Gonzalez Bueno. That is coming up next. Banco Sabadell posted a 75% rise in fourth quarter net profit, boosted by its business in the UK. The Spanish lender reported 532 million euros in net profit in the period, ahead of expectations. For the full year, it reported a record profit of 1.8 billion euros. I'm pleased to say Cesar Gonzalez Bueno joins us now, the CEO of Banco Sabadell. Cesar, thank you so much for joining us again. Every time you produce a strong set of numbers, the market questions whether it's right to be consolidated by BBVA. So just talk us through the latest numbers.
Well, I think let's see how the market reacts, but we are extremely satisfied. As you mentioned, 1.8 billion, it's a 37% up for the year. And I think one of the things that might be interesting is to see the reaction to the announcement that in the next 13 months, the return to shareholders is going to go up to 22%. That is unparalleled and unseen in the market. So let's see how it reacts.
Indeed, and as we talk about some of the metrics too that investors will be digesting, you see the ROTE, the return on tangible equity profitability, to maintain at 14% this year and above that target in 2026. What are the drivers here that are working for the business in a context where we do have interest rates coming down from the ECB?
Well, we're firing from all engines. I mean, we have a growth that is higher than the market. We are gaining market share. We are reducing our cost of risk, or our risk cost. We are managing very, very steadily our costs. And in general, the spirits at the bank, also fueled by the hostile takeover, are fantastic. For the last 4 years, we have multiplied our market value by 8 times. This is number one in the Spanish stock exchange and number one among all European banks. This phenomenal transformation is only set to continue.
Cesar, lovely to see you. And look, your share price before and after the bid intentions speaks its own story. I appreciate that. But let me ask you about the counterfactual. Why wouldn't Spain and Europe benefit from a stronger BBVA and Banco Sabadell? You are strong, BBVA are strong. I know you, and of course I know the CEO there. You're both fantastic managers of your business. But wouldn't it be better for Spain and Europe to have more titans in the banking industry?
Let me be very clear around this. Mergers are good. If they are consolidation, even at national or cross-border, they are good. There's only one limit. When the value is not there and when the buyer is not paying what it should be paying. And second, when the concentration is so large that it creates so big execution risks. Everybody's against this transaction. 79 associations of entrepreneurs and business people have shown against. All the political parties, the trade unions, everyone is against. Why? Because Sabadell is providing services that are extremely relevant for the SMEs. We are the 4th largest bank in Spain, but we are key for the SME business. If we disappeared, the competition would suffer. And that is creating this phenomenal execution risk because it is the result of a social reaction to something that Spain does not want. And of course, as I said at the beginning, on top of that, they are not paying the price.
Cesar, I'm sure you have had and probably still have a reasonable relationship with Mr. Genk and Mr. Torres Villa as well. They're both very reasonable gentlemen as well. Can this not be worked out between 3-4 very reasonable gentlemen at boardroom level rather than this just very hostile back and forth?
You're absolutely right. These gentlemen are fantastic and they have all our respect. But this is the time now for the shareholders to speak. That is the choice that has been made, and there's no further arrangement that can be done from a factual perspective. The only thing that the board could say is in the first 10 days of the tender, if the offer was fabulous, which it's absolutely not, it could consider if it recommends to its shareholders to accept or not to accept. For the time being, and with everything that it's on the table, the answer is a very, very clear no.
Cesar, so we've just heard some metrics there that you're looking for when it comes to the deal activity. Can I ask you about the politics here? Because the move back to Catalonia, some are thinking may be linked to the M&A, that you're looking for some support from the Catalan government. This after your company had departed that region with the independence push a number of years ago, something we covered on this channel. What sort of engagement have you had from the Catalan government as you've moved the headquarters back to that region?
The only reason to come back, I mean, look, Banco de Santander is based in Santander. Banco Bilbao Vizcaya, Argentaria, which is BBVA, is based in Bilbao. Banco Sabadell is based in Sabadell. It's only reasonable to be where we have been for the last 140 years. We were the first ones to leave Catalonia when there was a moment of turmoil, and we have been the first ones to return. We are where we should be.
Cesar, final question. I want to come back to your answer from my last question to you, and I'm fascinating. You said if the offer is fabulous, then we'll have to reconsider. So there is a deal to be done at the right price.
Well, the obligation of every board member is to look after the interest of their shareholders. The thing is that Carlos and Onur have said ad nauseam that they are not going to increase the price. Furthermore, they've said in writing almost, the 29th of April already, when they announced by letter to our board that there was no possibility of improving the price and therefore there was no negotiation possible. They said that they had dropped by 6 billion in a short period of time after the offer they made. And if they increased the price, the value destruction that would come to BBVA, which is a larger player than Sabadell, would be by far greater than the increase of price that they could pay to Sabadell shareholders. So this is the thing. And the value creation that is there makes it extremely difficult that they increase the price. Therefore, my anticipation is that this deal is absolutely not coming through.
Right, Cesar, you've put the ball very firmly back in Mr. Torres Villa's court as well, Mr. Genk's court. If they want to come up with a better price that potentially could have value accretion, well, then let them bring it on. But fascinating. You're all such nice people. It's amazing to be here chatting to people on so diametrically opposed views. Cesar, we've got to let you go. Thank you very much for your time. Cesar Gonzalez Bueno, who is the CEO of Banco Sabadell. How privileged are we? We get to chat to all these amazing people who are diametrically opposed in their views on this absolutely live story.
Yeah, and you didn't even mention the Spanish government, the finance minister, who's had his 2 cents too, who's
I'm sure.
a credible individual.
It sounds like Germany, doesn't it? Apart from the fact they've got growth in Spain.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.